Hello, everyone. My name is Josh Powell. I'm currently in the first of my last four classes of this program, Capital Markets and Institutions, which is taught by Igor Glisick, and I chose to do my financial analysis on Goldman Sachs. Goldman Sachs is a financial institution that has been offering financial services to a substantial and diversified clientele that includes corporations, other financial institutions, governments, and individual people. It was founded in the year 1869, and they have grown to now maintain financial offices all over the world, but are headquartered in New York City. Goldman Sachs offers several different financial services, including services in securities, investment banking, investing and lending, investment management, and research and analysis in the equity, fixed currency, and commodities markets. In 2008, during the financial crisis, Goldman Sachs was deemed too big to fail by the U.S. government and was given a $10 billion investment from the Department of the Treasury as part of the emergency bailout program created by the U.S. government. According to the U.S. Securities and Exchange Commission, Goldman Sachs helped start the financial crisis by deliberately selling packages of low-quality mortgages, a product that they knew and intended to be flawed, so they could make even more money off their product. Goldman Sachs and other institutions were offering easy access to money to just about anyone. Borrowers were able to get high-risk mortgage loans and qualify as subprime borrowers without a good credit score or providing any documentation. Some financial institutions went so far as to commit fraud by adding information that was inaccurate on loan applications to help borrowers qualify. Eventually, this kind of behavior by Goldman Sachs and others led to the collapse of the housing market and the financial crisis. People started defaulting on their loans in unbelievable numbers. The government was then forced to bail out some of the biggest financial institutions and banks to keep them from failing. Now, a decade after a financial crisis rocked the U.S. and the world, Goldman Sachs is doing remarkably well. They have managed to redefine themselves, become stable, and expand into new markets. Goldman Sachs has since rebuilt their reputation from the destruction it caused itself during the financial crisis and has come back stronger than ever while also establishing good credit ratings. Currently, Goldman Sachs' performance in the market is going remarkably better than expected. In October of 2017, Goldman Sachs reported the best revenue numbers it has seen in over 3 years in some of the departments. It was declared in October that the earnings per share blew away analysts' expectations by nearly 80 cents. As for 2017 as a whole, Goldman Sachs had an up year when compared to 2016, increasing revenue by $1.5 billion. For the 2017 year, Goldman Sachs reported net revenues of $32.07 billion and a net earnings of $4.29 billion. In 2017, Goldman Sachs ranked first in the world with worldwide announced and completed mergers and acquisitions, as well as first in worldwide equity and equity-related offerings and common stock offerings. Investment banking was a substantial driver for Goldman Sachs revenue, producing its second highest annual performance ever. The investment management group also recorded great net revenue of $6.22 billion. There's also a significant advance to Goldman Sachs online consumer lending. Over $2 billion of loans and over $5 billion in growing online deposits were generated using the online platform Marcus by Goldman Sachs. Goldman Sachs also returned nearly $8 billion of capital to common shareholders during the 2017 year. However, not all figures reported were great. Goldman Sachs took a major hit in its trading business. The bank's fixed income, currency, and commodity revenue in the trading business was down 26% on a year-on-year basis in 2017. Another thing that did not look good on the financials was a significant decrease between 2016 and 2017 under Goldman Sachs Institutional Client Services. Goldman Sachs recognized a 34% decrease in revenue from that department between 2016 and 2017. These are the two blatant weakest areas of Goldman Sachs financials, and they're the areas I would like to see improve. The loss of revenue over 1 year in these two departments is rather astounding. As for the trading business, Goldman Sachs provides a service to clients that allows them to trade securities and commodities electronically. They provide the service for clients to buy and sell commodities, and Goldman Sachs offers professionals to lend advice to these clients on what they think the markets might do. Goldman Sachs' diverse portfolio allows the bank to almost always make money, even if some departments struggle. A 26% decrease in any part of a business is something no executive, board of directors, or stockholder wants to see. Goldman Sachs has the capital and capability to set up its own commodity trading department. As a matter of fact, the startup could be relatively easy, being they already have trading and market experts that work for them who are currently advising clients. There are so many commodity options, it is completely possible Goldman Sachs could make a substantial income without having to raise a massive amount of funding to get started. I would suggest Goldman Sachs look into trading natural gas commodities, as well as other commodities. They already offer advice to investors in the energy markets, so they might as well take a piece of the pie for themselves. So many experts are always looking at silver and gold and oil and copper. Yes, there is money to be made buying and selling oil and gold commodities, but at the right time of year, the margins for buying and selling gas can reach $6 to $10. Places like Chicago and cities in the Northeast like Boston and New York are massive natural gas hubs, simply due to the amount of people that live in those areas. The demand is naturally the highest there. Goldman Sachs is already headquartered in New York City. They also have offices in Chicago and Boston as well. Goldman Sachs already has the primary locations to set up shop and get the ball rolling for their natural gas trading desk. Some of the cheapest gas in North America comes out of West Canada. They also happen to have offices in Calgary and Seattle. Goldman Sachs would not be the first financial institution to trade in natural gas for themselves either. I currently work for a natural gas marketing company, and we do business with other major financial institutions on a daily basis. Those financial institutions have seen the potential to make a substantial profit selling natural gas commodities as well as other commodities and are taking advantage of the opportunity to add revenue to their books. If Goldman Sachs wants to trade natural gas, they will need to be able to purchase rights to flow gas from pipeline companies on pipes throughout North America. This could cost millions, depending on how much space in the pipe Goldman Sachs will be willing to purchase, but the profits are there for the taking. If Goldman Sachs doesn't want to finance the funds themselves, they'll be able to borrow from another financial institution, such as Bank of America or JP Morgan, who have the funds to provide such a loan. As of 2016, Goldman Sachs still had a fair amount of equity, meaning it shouldn't be a problem to receive a small loan of a couple $1,000,000. By my incredibly conservative estimation, Goldman Sachs could make an additional $400 to $5 million per year in additional revenue by opening its own trading desk and trading in natural gas and other commodities. If anything, it is a significant way to cover large losses, much like the 26% loss that was taken in 2017. With the additional profit, Goldman Sachs can work to reduce its debt to achieve a safer debt-to-equity ratio. Also, by adding its own trading desk, Goldman Sachs can further diversify its already incredibly diverse portfolio, all the more lowering their overall risk as a company. When it comes to the second problem, the loss of revenue from the institutional client service department is somewhat understandable. Goldman Sachs is slowly pushing people toward using their online platform to receive quick, easy loans and make easy transactions. The online platform alone moved over $2 billion to clients in 2017. However, what Goldman Sachs does is provide a service to people by giving advice on how clients should handle their money, and those services still need to be a high priority. While reducing costs to clients for services can be a good thing, Goldman Sachs still needs to be in good contact with all of its clients. It may cost extra funds, but I propose Goldman Sachs should be reaching out to employees on a more consistent basis to ensure all their needs are met and discuss the current status and future of their clients' money and investments. It would not cost millions to set up this process. Being Goldman Sachs is so large, they could also offer online face-to-face chat with clients who have questions or concerns or need advice. Setting up that personal relationship with businesses and clients can go a long way to ensure their loyalty to Goldman Sachs. By being more available to clients, the client is more liable to buy, sell, and move their money around. This is good for the economy, it could be good for the client, and it will be good for Goldman Sachs, being as a commission and fees are charged for the services. I feel that with a good rejuvenation of Goldman Sachs customer service, the institutional client services revenue could be turned around and make a significant contribution to the overall revenue of Goldman Sachs. Revamping the client service department shouldn't need much funding, maybe $100,000 to $200,000 to implement new technology and provide the service to hundreds of thousands of clients. If Goldman Sachs would have had a trading desk to trade commodities of its own in 2017, the trade business would have made over $2 billion in business trading rather than taking a 26% loss. The earnings in their own trades would have covered any losses. The additional income would have pushed the total revenue to over $32.5 billion, nearly a $2 billion increase from 2016, which shows fantastic growth to the board and shareholders. If Goldman Sachs can revamp its customer service department to better keep in touch with clients, it could have an impact on shareholders as well. There was a near $2.5 billion loss in revenue from 2016 to 2017 in the institutional client services department. With more client interactions in 2018, Clients will have more information and will potentially make more changes to their accounts, further helping Goldman Sachs add commissions and fees to replace our lost revenue, all while putting more money in our clients' pockets by better serving them and their needs. Even if Goldman Sachs could recover $1 billion in revenue lost from 2016, shareholders will see substantial returns in dividends, and Goldman Sachs will continue to grow at a steady pace heading into 2019. In the short term, these plans together will cost millions. That will be the cost every year, but those costs can easily be recovered and substantial profits can be made. Every year, as business and personal relationships arise and improve, the trade desk will thrive and make a substantial contribution to overall profits each year in and out. Overall, Goldman Sachs is standing on a solid foundation for the start of 2018. They already have an incredibly diverse portfolio, their stock price is at an all-time high, and some departments are coming off record revenue numbers for 2017. We have identified the two weakest spots in Goldman Sachs' portfolio and have put together plans to improve on these weaknesses. The first is to add a trade desk where Goldman Sachs can trade its own commodities and create another form of income while further diversifying the portfolio. The second plan is to revamp customer service to better reach the customers. Substantial profits were lost between 2016 and 2017, and with this plan to better reach clients, Goldman Sachs can look to reclaim some of the lost profits from 2017 in 2018.